You look like a god at the moment in that you've gone for your downgrade. But you've downgraded equities on a 3-month basis. You remain overweight on a 12-month. How deep a conviction to this downgrade is it?
Listen, it's a key question. I think right now the uncertainty is still incredibly high. And I think on the momentum side, on the fundamental side, there is no reason for joy. Like growth momentum, inflation momentum, policy momentum, no good news. I think it feels very uncertain. But I think the only good news is we all know that. I think people are bearish, sentiment is low, valuations are coming down. And that means usually in the long run, the asymmetry, upside versus downside, is getting better. So that's kind of why we are reluctant to be bearish now with everything we know, because I think everybody is a bit like that.
Danny, jump in.
Yeah, so no good news. I mean, again, a grim assessment of the current term, but it continues to get worse, Christian. I mean, seeing what markets have done this past week, are you not tempted to say, okay, it's not going to be fat and flat, it might be fat and pretty painfully down?
Well, I think you make a good point there. I think one thing we're worried about is clearly that recession risk, which everybody's talking about. I think if you look at our economist view, but also our internal models that look at lead indicators for recession risk, I think we put that probably at 20-25% for the next 12 months, 35-40% kind of for the next 24 months. That's not that high, but if that goes up, you could definitely see the market get a bit more worried. You also see that credit year to date has been incredibly resilient and is starting to catch down now. And that worries us a bit because it tells you that maybe the fundamental momentum deteriorates enough to feed into second round effects and really cause more issues.
And this is the debate. BlackRock sat in the seat just 20 minutes ago with you, and they said there's no reason to be short investment-grade credit at 4%. Yes, credit has underperformed, but not as bad as sovereigns. What kind of recession? This is the debate, isn't it? We've just had it. It could be a consumer-orientated recession or a full-blown, typical one that we all know has the hallmarks of hell on it.
Yeah.
Which version of recession is most likely?
Listen, that's the key question. I think we know we just had a recession 2 years ago.
Yes.
So that means like there's a bit of a survivorship bias. The companies that are here now have just been through a very tough time. So that's good. So the private sector balance sheets are actually quite strong. So you didn't have this long cycle where leverage would kind of increase, and then eventually you have a big unwind of imbalances. And generally, like financial imbalances are difficult to pinpoint. No, like right now you can't really say this is actually a big bubble, this is a big bubble. I think at the margin it feels like the private sector is in good health. Cash to asset ratios are actually 15 to 20% in Europe. So there's a lot of buffer. So we would be in the camp that the recession should theoretically be mild. But what I'm worried about is always risk premium. Like in an asset, there's always the cash flow and the risk premium. And I don't think that the equity risk premium and credit spreads are discounting as large of a recession or even mild recession to the full extent that
so that's my risk.
Exactly.
Danny.
Yeah, this is the really interesting thing, Christian, because there seems to be a lot of disagreement to this point. JP Morgan, Marko Kolanovic says stocks currently pricing in 70% odds of recession. UBS has said 40%. In your mind, we're not there yet. We're not pricing in a recession. What would pricing in a recession look like?
It's a really interesting debate. If you look underneath the surface within equities, cyclicals versus defensives are pricing 60 to 70% probability of a recession. So I agree on that. Cyclicals versus defensives are already very bearishly priced. But if you actually look at the headline index, like the drawdown we've had in the S&P, the level of the VIX, and the equity risk premium, we don't really see as high of a probability being priced. So that's the conundrum you have. I think underneath the surface, it's bearish, but on a headline basis, I think it's difficult to rule out further declines because the equity risk premium is relatively low. Don't forget, bond yields have increased a lot. So at the margin, that lowers the equity risk premium.